Good morning, ladies and gentlemen, and welcome to the Cathay Bank Economic Outlook virtual seminar this morning. My name is Chang Liu, President and Chief Executive of Cathay Bank. Today marked the 7th consecutive year that we have collaborated with UCLA Anderson Forecast to explore the U.S. China economy. We are delighted to share insights into the current economic landscape and its future trends with our valued clients and prospects. This year, amid concerns regarding the unpredictability of U.S. job market, there has been volatility in the stock market, which drives treasury yields lower. The result of the upcoming presidential election will also impact the country in drastically different ways. How will these developments affect the U.S. economy? How might U.S.-China relations evolve under a potential Trump or Harris administration? These are crucial issues that merit discussion. Serving as a director and senior economist of the UCLA Anderson Forecast, Dr. Jerry Nicholsberg is a highly respected expert in the field of economic modeling and forecasting, focusing on national, California, and regional economies. We are fortunate to have Dr. Nicholsberg with us today to share his perspective on the complexities affecting the U.S. and China economies and whether the U.S. can curb inflation and avoid a recession. Without further ado, please welcome Dr. Nicholsberg.
Today I'm going to talk about the U.S. economy and the Chinese economy and what that means to the extent that we know it for the upcoming couple of years. Okay, and I presume that you all can see that. Is that correct?
Yes.
Great. So I have two pictures here to start out with. And let's start with the one on the left-hand side. This is a cartoon and it shows the unemployment office. A lot of discussion about labor markets, weak labor markets, and the like. Discussion that seems to indicate, at least kind of under the surface, that we are heading into a weak economy, a contracting economy. And I think what we want to do is look behind those comments, look at the data and see what the data actually says. Do we have a weak economy or do we have a very good economy? Is it a soft landing? Well, I think we can put the soft landing kind of behind it. You see two images here. One on the left-hand side is one of the unemployment office. And there's been a lot of discussion about a weakening labor market. And we want to try and understand what that means, a weakening labor market. Is it a bad labor market? Does this portend a move into a recession? Are we still talking about a soft landing when the pundits were saying that in 2022 and 2023 it was soft landing versus recession? Well, now we're in 2024, almost to 2025. I think the soft landing discussion should be behind us. We did indeed have inflation come down and GDP is still going strong, and I'm going to show you that. The one on the right-hand side, I think, is maybe more important. Any economic forecast that you see today has an underlying assumption of what's going to happen in November, and that matters a lot. We have both a presidential election and a congressional election, and our assumption is that regardless of which party takes the White House, that the Congress will be divided between the two parties, and therefore we will still have gridlock, and that's kind of the image that we have there of gridlock. So let's look at where we're going to go today. We're going to start with the U.S. outlook, and then we're going to go to the China outlook, and then talk a little bit about U.S.-China trade and the implications of the election for that. So beginning with the U.S. and the macro outlook, the most significant recent event was the Fed cutting its policy rate for the federal funds rate, a very short-term interest rate, by 50 basis points. And you see that here from this graphic that comes from the Wall Street Journal. And you have a decline of 50 basis points. And then to the right there, where you see that dashed line in those bubbles, those are the projections by the Federal Reserve members, the presidents of Federal Reserve banks who are members of the Federal Open Market Committee, plus the governors of the Board of Governors of the Federal Reserve System. And this is what they think policy is going to be going forward. And as you can see, they very much differ. And they have the federal funds rate declining all the way through 2027 to below 3%. We don't think they're actually going to get to 2.9%. We think it's going to stop in the 3% range. And the reason being that the economy, which I'm going to show you our forecast momentarily, is going to be growing. We're going to have decent employment, and they really don't have much of a reason to go below that. But why are they reducing interest rates today? Let's take a look at some basic data. And the first thing that I want to show you is the unemployment rate. The unemployment rate in August, our latest numbers, was 4.2%. And if you look here, this is 2022, 2023. We are down below 3.6%. We're at 3.5% unemployment. And today we're up at 4.2%. So it sounds like things are getting worse. But the question we want to ask is, are we going from an abnormal, overheated labor market represented by that sub 3.6% unemployment rate to a normal labor market with an unemployment rate of 4.2%, or from a normal market at 3.5% to an abnormal weak labor market at 4.2%. And I'm going to show you some numbers that help us understand which one of these is correct. And this is the unemployment rate, and it goes all the way back. And if you notice, so look on the right-hand side, that's where we are today. And then kind of trace a horizontal line, and you have to get back into the 1970s until you find an unemployment rate that was as low as it is today. And of course, the 1970s was a very different economy than the one we have today. Indeed, in the 1970s, our trade with China was virtually nil. And so certainly the unemployment rate is not unusually high. In fact, it may be pretty normal. So unemployment rates need to be above zero because you have people coming into the labor market, new entrants, and they're looking for jobs. When they're looking for jobs and trying to find the best job, of course, they're unemployed. You also have people who leave their jobs, either voluntarily or maybe their company went out of business. Companies come and go all the time, and then they're looking for a new job, and they're unemployed. So for a labor market to operate efficiently, you need some unemployment, what we call the natural rate of unemployment. And here's the real question. Was 3.6% or 3.5% a natural rate, or is it more like 4.1 to 4.3%? Let's look at some more data here. These are layoff rates, so it's monthly initial claims for unemployment insurance, and it is divided by the monthly payroll employment, so that would be the layoff rate. And again, look all the way over on the right-hand side, and then draw a horizontal line. Our layoff rates are at historically low levels. All of this suggests that even though the unemployment rate has gone up, it's actually gone up to being fairly normal. And one other piece of data, I don't have a slide on this, is what's happening with wages. When the unemployment rate was 3.5%, you heard a lot about labor shortages. Wages were going up faster than inflation. Today, much less about labor shortages, and wages are going up about equal with inflation. That suggests that we're more in the natural rate of unemployment in the 4.1 to 4.3 range, and we were in an overheated economy early on. And so the economy is just adjusted. Well, what about the job gains that are now down in the 150,000 per month range, whereas they were in the 200,000 and 300,000? That is really dependent on how many people are coming into the labor market, and we have a very slow growth in our population, and therefore very slow growth in entrance to the labor market. Early on, we really were catching up to what happened in the pandemic and this big spike that you see here representing the pandemic lockdowns. So let's turn to GDP. And by the way, next Wednesday, we'll be releasing our latest economic outlook. So I'm going to give you hints as to what that outlook is going to be. We're just finishing up our forecast, and it'll be a bit stronger than the one you see here. This is our last one from 3 months ago, but what you see is the latest quarter that we have data on. So that's the second quarter of 2024, and it's a 3%. That's that black diamond that you see. We have 2.1%. We're going to make that a bit stronger in the next forecast, the one we release next week. Some folks have their forecast up at 2.9 to 3%. The numbers are coming in fairly strong up to this point, but we think our current month, September, which is the last one of the quarter, is going to be relatively weak, as well as the 3 months in the fourth quarter. And that's just due to uncertainty about the election. Investors want to wait to see what policies are going to be implemented in the next 4 years. And so they want to see the outcome of the election. And so they're holding back a little bit in terms of investment. That's going to give us a weaker economy, seemingly weaker economy, with sub-trend growth for next quarter, the fourth quarter of this year. And then we have growth in the 2.6 to 3% range going out in our forecast. And that reflects all of the underlying strength of the economy. We don't really have any imbalances in the economy, and it reflects new technology both being adopted by firms and being developed, particularly developed here in California. So it's a fairly optimistic forecast, but that's because the underlying numbers don't really show us any real weakness in the economy. So let's turn to inflation. And this is important in understanding what's happening with interest rates, because interest rates, the interest rates that we see in the market, are interest rates that include a margin for inflation. So the real interest rate, which is the market interest rate minus the rate of inflation, gives you the interest rate in inflation-adjusted terms, and that's the important one for monetary policy. It's the important one for decisions. So here what you see is something called headline inflation, which includes all goods in a average American household's purchases per month, and core, which takes food and energy, both kind of with volatile prices, out of the mix. And the August numbers are 3.2% for core and 2.9% for headline. And by the way, the lines here are quarterly averages, but I do point out the latest monthly numbers. The metric that the Federal Reserve uses is called the Personal Consumption Expenditure Index, and that is very similar to the Consumer Price Index, and they kind of go hand in hand, they move together, but that index is down in the mid-2s. Both of these are being held up by two things that are not sensitive to interest rates. One is the repair of automobiles and the insurance to cover that, and that's simply because our new cars are much more sophisticated than older cars. They take highly trained technicians to work with all of the sensors and so on, and they're just much more expensive to repair. And an increasing percentage of the fleet of cars that are operating in the U.S. are newer and more expensive to repair. So interest rates don't affect that. The other is in rents, and rents are 1/3 of these indexes. And rents are the average rents that people are paying. What happens is when someone rents an apartment or a home, they get a long-term lease. And if they've been good tenants, at the end of the lease, if the tenants want to stay, the landlord would like to have them stay, the landlord may raise the rents, but they're not usually going to raise them to market. And we also have rent stabilized units, which only go to market when those units are vacated. So some of that happens every year and you move closer to market, but it takes a long time for all of the rents to get up and to reflect rent increases that happened over the last 3 years. Right now, rents are not going up on average in the U.S., but in the Consumer Price Index and the Personal Consumption Expenditure Index, they are, because average rents are going up. Again, interest rates don't affect that. So what is driving the Fed to lower interest rates? As the inflation rate comes down, and we have it coming down slowly, it gets under 2.5 at the end of 2026. But as that comes down, the real interest rate, the inflation-adjusted interest rate, goes up. That is monetary tightening. That makes it more expensive in inflation-adjusted terms for firms to invest, for people to buy homes. And so all the Fed is really doing is adjusting interest rates so that the real interest rate stays constant. And so we have monetary neutrality in an economy with full employment and at or above trend growth. So let's take a look at some sectors here. And so these are going to be the interest-sensitive sectors. And the first and most important is in residential construction. And I want to emphasize this because we're going to talk about it when we get to talking about the Chinese economy. In the U.S., from 1947 to present, which is where we have reasonable data, we had 7 recessions, all of which were associated with a dramatic decline in residential construction. The other recessions were associated with an end to overseas conflicts, to wars, and a sharp cutback in defense spending. For example, at the end of World War II, at the end of the Second Korean War, at the end of the Vietnam War, and the 1990 recession, which was the end of the Cold War. And then we had one recession with an overbuilding of computers and software, and that was 2001. So residential construction is quite important when it comes to whether or not we have a recession. So now let's take a look at the chart. These are new building permits. It's seasonally adjusted annual rates. That's what that SAAR means. And if you look over on the left-hand side, with a 4.1% average 30-year fixed mortgage rate, in the U.S., 1.3 million homes were being built each year. That's underbuilding. We need something up close to 1.5 million just to keep pace with population gain and household gain. And we've been underbuilding for a long time. Then there's something called the pandemic surge here. And during the pandemic, we wanted larger apartments, larger homes, because we were working at home. And so you saw a surge in building to take care of that new increased demand. Some of that made up for underbuilding, but not much. And so when you look today with higher interest rates, building has gone up to about the 1.5 million historical average rate. So we've got an increase in building with higher interest rates. And there are a couple of important points here. One is that mortgage rates today are not abnormally high. They were abnormally low up until recently, up until the Fed started raising the federal funds rate 3 years ago. And when they were abnormally low, households locked that in. They did a lot of refinancing, and now they're at 2.5% to 3.5% mortgages. And for a long time, households were not vacating their homes. They were not selling their homes in normal ways to avoid going into a higher interest rate mortgage. That's still going on. But the largest population cohort in the U.S. are millennials aged 31 to 33. And that's the age when people start buying homes. They start thinking about having families, looking for larger places. And where are they going to buy homes if boomers are not selling their homes? They're buying newly built homes. And that's created a demand for new residential construction. And one of the things that really has held up this economy in the face of higher mortgage interest rates. Now, mortgage interest rates are going down, and people are getting used to the new interest rates. And so we are expecting both a normalization of existing home sales as well as increased building of new homes as we move forward in the forecast. And that's part of the reason why we have growth in our forecast going forward. Another interest-sensitive sector is durable goods. So these are non-defense durable goods because defense goods are not interest-sensitive. And what you see is that we're in nominal terms, so not inflation adjusted, we're at record levels, but it's kind of tapered off, and part of that is this uncertainty about the election. But still at record levels, and backlogs at manufacturers are going up. And we expect this then to increase again after we get some clarity as to policy post-November. So interest rates went up, but in this economy, in the post-pandemic economy, firms have been demanding new software and new equipment in order to keep up with the changes that have occurred over the last 5 years. So this is another source of strength. And we're expecting, in fact, in manufacturing, fairly significant growth because we have new industrial policy through the CHIPS Act, the Infrastructure Act, the Inflation Reduction Act, and just the position of Washington. And you can see that in new factory construction. It kind of goes along with a trend, and it's kind of a shallow trend, and then just takes off as soon as this industrial policy has taken hold. And so we have factories that are going up all over the country, including here in California. And these are going to come online in 2025, 2026, and 2027. And what that's going to do is create new jobs, new output, and spur economic growth. So let's take a look at some other sectors in the U.S. And I want to look at consumption and defense, and then take a look at the energy that fuels our economy. So first, consumption, it remains strong. I drew this dashed red line, and you see consumption. This is adjusted for inflation. It went up above trend, and then there was a thought that, well, consumers have high debt, and they're going to pull back. The stimulus from the pandemic is all spent, and we're going to have a pullback. We have student loans, high student loans. You don't see any of that in these numbers. Post-pandemic, we want to spend. We have lower savings rates. We want to particularly get out there and take advantage of services, and we're buying goods like recreational goods that support what we want to do now, and we really want to consume more now rather than wait till later. Lower interest rates are going to keep this going, and consumption in the U.S. economy, and this is true about most advanced economies, is about 2/3 of the economy. It's a very strong part of the demand that drives economic growth. We're going to talk about that a little more when we get to China. And then we clearly have a more dangerous world. That means increased defense budgets, not only here, but amongst our allies in Europe and Asia. And so we have that additional demand that is going to be coming in the next 3 years. The demand from foreign markets, about 40% of that comes to the U.S. This is disproportionate for California. It's California, Texas, Georgia, Connecticut, a little bit for Washington and Arizona, and that's about it. So California, particularly Southern California, will benefit from this increased demand for defense durable goods manufacturing. And then finally, we take a look at oil prices and oil production. Oil prices, that's the orange line there. And this is West Texas Intermediate. And it's been hovering around 80, but in the last few weeks, it's been down, hovering around 70. And Brent crude and the other oil prices are also down in the 70s. And the top line that you see is U.S. oil production. The U.S. is now the world's largest producer of petroleum, and it's just been increasing with these prices, particularly in the Permian Basin and in the Eagle Ford Shale. And so oil prices are not going to be a drag on the economy. In fact, if you look at futures, for example, the futures price for unleaded gasoline, and this is a nationwide average, is under $2 a gallon. So again, a source of strength for the economy, which gives us our U.S. outlook summary. Employment and income remain strong. Investment and consumption continue to drive economic growth. We have interest rates falling, and we have more decreases coming. And we have infrastructure, industrial policy, and defense just layering on demand that's going to keep the U.S. economy growing through the next few years. So to talk about a recession is true. A recession is coming because it eventually comes. But the data that I showed you, and we could have spent the full hour looking at other data, does not have a recession in it. It has none of the elements that give us imbalances that drive the economy into a contraction. Now, there can be geopolitical events that would drive us into a recession, but at least the data says, given our assumption of gridlock in Washington, that we are not going to have a recession anytime soon. Okay, so let's turn to the China macro outlook. And I want to start again with GDP. And if you look at this chart and look at the blue line here, these are the official China National Bureau of Statistics numbers for GDP growth rates. And as you can see, there's been a long decline. That's a well-documented and discussed decline. And the last two numbers on the right are 5.5% and 5% growth in the economy. So for 2024, it's 5%. But these numbers reflect the way in which the China National Bureau of Statistics calculates GDP. So if we want to compare it to, for example, the U.S. and understand it in kind of a U.S. or a Western economy, a market economy context, we need to adjust those numbers. And what we have done at the UCLA Anderson forecast is build a model which is calibrated on 10 Western economies. So that's US, Canada, Germany, France, the UK, Australia, Japan, and so on. And then see what that model tells us about the Chinese economy when we calibrate it for the Chinese economy. And that's the red line that you see there. And in terms of correlation, it tracks pretty well, but it is usually and significantly below the official numbers. And a big part of the reason for that is that in the Chinese economy, you have a lot of investment, and investment that doesn't have a market value. So for example, in housing, I think we all know there are many, many homes that are sitting empty because they don't have any buyers at the prices that the Chinese government is holding them up at. But that new construction is valued at those higher prices. If you let the market work and prices fall to the point where people are buying those homes, which is what would happen in the US or happen in Germany or in Japan, you would see prices fall probably by about a half. we put into our model that they fall by 30%. And what that does is that results in an estimate that in our Western frame of reference is an economy that's growing at 0.7%, which is not significantly different from an economy in a recession. And just to digress for a moment, if you're thinking about the U.S. economy, for example, and we had the kind of overhang of excess residential construction, of infrastructure construction that is earning a negative rate of return, we would see a recession. Every time that's happened in the U.S., happened in European economies. In fact, we're seeing it in Germany today, and has kind of happened across market economies. We're in a recession. What that tells us is not necessarily that China is in a recession, but that China is in very deep trouble in terms of economic growth. And we can see that in some of the imbalances that are going on in China today. And that's going to really reflect on what's going to happen in the future in China. So investment in China accounted for 42% of GDP in 2023, extraordinarily high for any country. It was up not at those levels, but getting to those levels in Japan before Japan had a what's called a lost decade, a stagnation of 10 years or more. But that 42% is only down 1% from 1 percentage point from 2021. Household consumption was at 39% of GDP. You remember for the U.S., it's 2/3, it's almost 70% of GDP demand. So household consumption, which is very weak today in China, is not a big driver of growth. And so in this chart, you see nominal, so not inflation adjusted, fixed asset investment growth rates, and it's year over year, and 2024 has been annualized to make it comparable in the full year. So the primary industry is going to be agriculture. So we see secondary, which is held up, and that's investment in manufacturing, where there's overcapacity in China, and in infrastructure, where there's also overcapacity in China. And then tertiary is services, and services, the investment has basically dropped to zero. And services gives you a little better idea of what's happening with private investment. If we break down that top line there are few profitable investments in infrastructure remaining. Infrastructure, we're talking about airports, roads, high-speed rail, but Beijing continues to rely on an investment growth strategy. That gives you those artificially high GDP growth rates when compared to on an equal apples to apples basis, the U.S. growth rates. But here we have it broken down, which really gives you an illustration. Power generation might be valuable in the future, not so much in an economy that's really starting to stagnate. Manufacturing, that's the dark black line. And we're going to talk more about manufacturing because the Chinese consumers are not buying those manufactured goods at a rate that would give you any increase in manufacturing. Real estate, of course, is negative, and it's a big negative. And again, those kinds of big negatives are what drove 7 recessions in the U.S. And transportation infrastructure. So one other strategy that the Chinese government is using today in order to boost economic growth and prevent widespread layoffs is exports. And so this has been well talked about, and what you see here, the blue line is exports, and they've jumped dramatically over the last couple of years and are staying high, and the trade surplus has gone up. So the strategy that China is using is to push out exports at very low cost and to keep people employed in manufacturing. And this is what's being called China Shock 2.0. China Shock 1.0 was after the admission to the WTO and factories moving from Europe and North America to China. In the left-hand panel, what you see here is growth of China's goods export value by main products. And this is the first 7 months of 2024 compared to the first 7 months of 2019. And the big spike there is vehicles, but then there's metals, so steel and aluminum, and then the average, and the next one, electrical and appliances. So these are being pushed out as exports as part of this export-led growth policy. And where do we see the growth in imports from China? Well, Latin America, Africa, Oceania, those are the top three on the right-hand side in the right-hand panel. Those are relatively small markets. And then the next one is Europe, and all the way over on the right is North America. Those are China's largest markets. And both in Europe and in North America, particularly the U.S., policy has been to restrict Chinese imports and to counteract this move to export-led growth, particularly in vehicles and in electrical vehicles. And so there's some real headwinds that China has to continue this export-led growth. In fact, it's not likely that this is going to be successful to drive 5% or better growth in the Chinese economy as we go forward in the next 3 years. Turning to the U.S.-China economic relations, the U.S. import dependence on China has declined significantly. And this has been a direct consequence of policy, of a decoupling policy, particularly in strategic goods. China is still a very important trading partner with the U.S. when it comes to consumer goods, but increasingly strategic goods, including things like rare earth metals, chips, etc., are becoming less and less important. And indeed, if you take China's share of U.S. GDP, imports from China as a share of U.S. GDP is actually a fairly small percentage. So a big hit to those imports will have a small impact on the U.S. unless U.S. policy interrupts supply chains, in which case it'll be like the supply chain interruptions that we saw going back in 2020 and during the zero COVID policy of China. So let's look at this chart and see what has happened. The blue is 2016 and the red is 2024. And this is the share of U.S. imports by origin, by region, by origin. And so going left to right, Mexico imports have increased by 2 percentage points. That is as a share. China, as a share of U.S. imports, has dropped by 8%. And then we have the increases with Canada, South Korea, Vietnam, Taiwan, India. The U.S. import community is diversifying, is recognizing that there are tariffs and that U.S. policy is likely not going to change vis-a-vis China regardless of the election. I'll say a little more about this in a moment. And so you've got diversification going on. And this is going to, China's share is actually going to decrease even more with the latest policy that reverses the ability of Chinese exporters to export to warehouses in Mexico and then send small lots to the U.S., small enough that would get under the tariffs. Now they're going to be facing those tariffs, and those goods will then become more expensive in the U.S., and we'll see fewer purchases of them. Last, let's take a look at the election. And again, I said we have two of the three pillars of government. The executive and the legislative branches represented here by these pictures. And who occupies the White House is going to matter for the U.S. economy because policies are very different between the Republican and the Democratic candidates. And what happens in Congress is also going to be very important. If we have gridlock, I think the data indicates that we'll continue on with the U.S. economy as it has been. If we don't have gridlock, but rather the Republicans control both the legislative and executive branch, then look for tax policy lowering taxes, less domestic spending, but importantly for our discussion today, increased tariffs on China, but also elsewhere, tariffs that will interrupt supply chains at least temporarily and will slow growth and increase inflation relative to what I just showed you in the forecast. That means we're going to have interest rates coming down not as fast as in our forecast, depending on how aggressive those tariffs are. And we don't know how aggressive they might be. One might see a real interruption in supply chains, one that would be significant enough to create the imbalances that would cause a recession. Now, this isn't a statement that is necessarily where the U.S. doesn't want to go, but rather there would be a transition from having supply chains that are international supply chains to supply chains that are much closer to home in the U.S., Mexico, and Canada. And that transition means that we'll have too many resources in one sector, not enough in another, and those transitions typically are associated with very weak economies and oftentimes a recession. But in the and then on the other side, if both are dominated by the Democratic Party, expect to see higher taxes on the wealthier Americans, lower taxes on the middle class. That will spur consumption demand, but also expect to see more spending and expect to see more regulation, which will increase the cost of goods. So in both cases, if we don't have gridlock, our forecast is too optimistic. But what about China policy? Will there be a reversal of China policy? Neither party, in fact, the idea of free trade with China in the U.S. is politically unpopular. Neither party is going to reverse course. And you've seen that going from a Trump administration to a Biden administration. On the Chinese side, we're also seeing a decoupling, and we don't expect a reversal of that. And then just kind of a final comment on the Chinese side, which is today, the People's Bank of China has lowered interest rates by 50 basis points, lowered the reserve requirement for banks, and has offered to make $70 billion of loans to buy equities in Chinese stock markets in order to boost the economy. I think a careful analysis of this suggests that none of this will be effective, and that for China to boost economic growth, it is going to need some fairly aggressive fiscal policy, which thus far the Chinese government has not been willing to engage in. And so in summary, China's economic outlook remains bleak for a prolonged period. So don't expect a resolution anytime soon. is manufacturing overcapacity and exports is likely to increase international trade tensions. The U.S. continues to implement this de-risking policy that is decreasing the risk of trade with China and enhance supply chain resilience. And despite election uncertainties and policy risks, one thing I think is very clear: the strategic competition between the U.S. and China will persist. And then a final comment: we always have geopolitical risk. And it, as we go forward, it's hard to say whether that is significant or not, whether there will be saber rattling on the part of both the U.S. and China, or whether there will be something more significant happening in the South China Sea, with respect to Taiwan and so on. But we don't have any of that in our forecast, but that is a risk and something to keep our eyes on. And so with that, let me stop and see if we have any questions.